Here is something that almost nobody frames correctly. A child born in 2005 had no choice in the matter. They did not choose the housing market. They did not choose the interest rate environment. They did not choose the labor market they would enter at 22. They did not choose the asset prices that would already be elevated by the time they had any money to deploy. They did not choose the student loan system, the pension collapse, the gig economy, the credential arms race, or the political coalition that had a structural incentive to keep exit costs high. They just showed up, and the machine was already running. The question nobody asks is, running at what settings and set by who? And for whose benefit? Because here is the uncomfortable truth. The same factory that made millionaires out of people who simply showed up stayed put and bought a house in 1983. That same factory with its same brochure, same promises, same career fairs, same get the degree, get the job, buy the house, max the 401k pitch, is now producing radically different output for people who follow identical instructions. Same steps, different math, and the gap between what the brochure describes and what the system actually delivers is not getting smaller. So here's what I want to know. What do you do when the rules of the game are different from the rules being described to you? We're going to explain how this system was built, who it was built for, how it got quietly reconfigured without anyone updating the manual, and why the gap between the promised outcome and the delivered outcome is not a glitch. It's a feature of how the machine works now, and understanding that clearly, precisely, without emotion, is the only way to make decisions that actually make sense given the world as it is. This is Creeper Finance. Here is the metaphor I want you to hold on to for the entire video because I'm going to keep coming back to it. Imagine a factory floor, long conveyor belt running from one end to the other. At the entrance, you step on, you're young, you don't own anything, the belt carries you through your working years. At the exit, if the belt is running correctly, you have a house, a retirement account, maybe a cabin somewhere, maybe just stability, something. The point is, the belt gets you somewhere. Now the belt has a speed, and the exit has a cost. And for most of the 20th century, the math was basically fine. The belt moved at say 4 miles per hour, and the exit cost you roughly 3 to 5 years of belt wages. You could save up, you could pay in, you could get out. Here is what happened. Over the course of about 4 decades, the exit got more expensive. Not a little more expensive. Dramatically structurally more expensive. But the belt speed didn't change much, and the brochure at the entrance of the factory, nobody updated it. It still says, step on, work hard, the belt delivers you. The people running the factory are not lying. The belt worked for them. They got out. Their exit cost them 4 years of wages. They assume yours does too. They're not checking. That's the whole video. Everything else is just detail. Let me start with the most quantifiable piece of this, because numbers are where the argument lives and where feelings can't distort it. Education. Specifically, the cost of the credential that the factory requires you to present at the entrance in order to stand on the belt at all. In 1980, the average yearly tuition at a 4-year public university in the United States was somewhere around $800. Adjust that for inflation using the Consumer Price Index, and you get roughly $2,800 in today's money. That's what it cost, inflation adjusted, to spend a year at a state school 4.5 decades ago. The actual current cost? Around $11,000 per year in tuition alone. Add room and board, required fees, textbooks that somehow cost $300 each, and you are looking at $25,000 to $35,000 per year at a state school. At a private university, $60,000 to $80,000 per year. Now watch how this interacts with wages, because this is the thing that makes the math genuinely ugly. An entry-level graduate in 1990 going into something broadly professional, marketing, accounting, management, HR, earns somewhere between $28,000 and $35,000 per year. Their total debt burden from a 4-year degree might have been $10,000 to $15,000, maybe a bit more at a private school. So the debt-to-income ratio was roughly half a year's salary to 1 year's salary. You could pay that off in 2 or 3 years of reasonable effort. It was a real cost, but it was not a structural trap. Now take someone graduating in 2024, entry-level salary in those same fields, $52,000 to $68,000. That sounds like progress. It's not once you factor in what they're carrying. A student who attended an average private university for 4 years and took on reasonable loan amounts is leaving with $110,000 to $160,000 in debt. A student who went slightly above average, a well-regarded regional school, maybe some graduate study, can be carrying $200,000, that is 2 to 3 years of gross income before taxes, before rent, before food, before any cost of being alive. This is not a minor headache. This is a structural weight on every financial decision for the first decade of your adult life. But here's the part I want you to focus on, because the numbers are almost secondary to the incentive structure that produced them. Universities do not have an incentive to price their product based on the financial outcome it delivers to graduates. They have an incentive to be prestigious, to grow their endowments, to fund research, and to admit students who make them look selective. Prestige and financial value for the student are correlated in some cases, but they are not the same thing, and the institution optimizes for the former. The mechanism that let tuition rise this dramatically without destroying demand is the government-backed student loan system. When a buyer can borrow unlimited amounts backed by the federal government to pay for a product and that debt legally cannot be discharged in bankruptcy, the seller has essentially no pressure to keep prices reasonable. The price signal is broken. The feedback loop is gone. The university can raise tuition 10% per year, and as long as the loan office is open, the seats fill. This is not corruption in any dramatic sense. This is just a broken pricing mechanism producing a predictable outcome. When you remove the constraint on the buyer's spending, the seller extracts more, every time. And the result is a generation that stepped onto the conveyor belt already carrying a debt load that functionally consumes the financial oxygen needed to do anything else. You can't save a down payment when 30% of your take-home is a student loan payment. You can't invest when you can't save. You can't compound when you can't invest. The chain of cause and effect here is not subtle. The belt charges admission now, that's new. The brochure doesn't mention it. Alright, education was the setup. Housing is the main event. This is where the numbers stop being bad and start being genuinely surreal. In 1970, the median home price in the United States was around $23,000. Median household income that year was roughly $9,000. The ratio, home price to annual income, was about 2.5 to 1. You needed 2.5 years of household income to buy the median home. With a 20% down payment and a 30-year mortgage at prevailing rates, this was within reach for most dual-income households within a few years of working. Current numbers. Median home price in the United States sits at approximately $420,000. Median household income, approximately $75,000. Ratio, 5.6 to 1 nationally. But here's where it goes from uncomfortable to laughable. In the cities where most of the actual jobs are, New York, Los Angeles, San Francisco, Seattle, Boston, Miami, Austin, the ratio is 8 to 1, 10 to 1, 12 to 1. In San Francisco specifically, if you want a median home, you are looking at roughly 15 years of median household income. That's not a typo. That's not an exaggeration. That's just what the number says. Let me run clean math on two people because I want this to be concrete rather than abstract. Person A buys a house in 1983, $200,000, which is a nice house in a good suburb. They put 20% down, $40,000. They take a 30-year mortgage. The interest rate in 1983 was around 13%, which sounds insane now, but their household income was around $30,000 a year. Monthly mortgage payment, roughly $1,800. That's about 72% of 1 month's gross income. Tight, but workable on 2 incomes. And critically, the $40,000 down payment was achievable by someone who had been working a regular job for 5 or 6 years and saving at a modest rate. They're not rich, they just got in. Person B buys a house in 2025. Equivalent house in a working metro area, $550,000, 20% down, $110,000. 30-year mortgage at 6.75%. Monthly payment approximately $2,950. Household income maybe $90,000 combined, which is genuinely aspirational for a young couple in their mid-20s. Monthly take-home after taxes in a moderate tax state, roughly $5,800. The mortgage alone is 51% of take-home, before utilities, before groceries, before the student loan payment, before a car, before anything. But that's the person who somehow scraped together $110,000 in cash. Where does a 25-year-old get $110,000 in cash? Most don't. Most don't get there until their mid-30s, by which point prices have climbed another cycle, and we start the calculation over. Here is the second-order effect that makes this genuinely structural and not just prices are high right now. The people who bought homes in the 1980s, 90s, and early 2000s are now sitting on assets that have appreciated 3 to 5 times in real terms. That appreciation is their retirement, it's their equity, it's the thing they're counting on. And they vote in local elections where zoning decisions are made at dramatically higher rates than renters. Voter turnout in local elections among homeowners over 55 is consistently above 60%. Among renters in their 20s, it's somewhere around 15 to 20%. Zoning reform, allowing more housing to be built, which would structurally reduce prices by increasing supply, is the most consistently blocked policy in local politics across the country. Because the people who own homes are correctly reasoning that if supply increases, their property values face downward pressure, and their property value is their retirement. They are not being malicious. They are being economically rational within their own incentive structure. The factory's exit is expensive partly because the people who already exited have a financial stake in keeping the exit expensive. And they have more political leverage than the people still on the belt. This is not a critique of homeowners. This is an observation about how systems work when asset ownership and political participation are correlated. The machine produces whatever output is consistent with the input from the people who control its settings. That's not a conspiracy. That's a feedback loop. The conveyor belt doesn't just charge admission at the entry now. Someone has placed a gate at the exit, and the gate costs $110,000 cash to open. The key is sold exclusively to people who already have significant financial resources, which is the part that makes it genuinely difficult for a first-generation wealth builder. Quick pause here. If this is the kind of analysis you've been looking for, actual system mechanics, actual math, no screaming, no 10 steps to millionaire by 30 energy, subscribe. I put out this kind of content consistently, and it's free. The information asymmetry in personal finance is real, and I'd rather close it. Now I want to talk about wages, because this is where the framing tends to go wrong. Most people, when confronted with the housing problem and the debt problem, land on wages as the culprit. Wages haven't kept up, and at the median that's directionally true. But it misses something important about what wages actually are and how they're determined. And it misses the fact that the wage conversation is kind of a decoy from the more important conversation, which is about leverage. Let me deal with wages first. Wages, like all prices, are determined by supply, demand, and substitutability. The wage for any role reflects roughly what it would cost to replace the person doing it, adjusted for the value that person's output generates. If your output can be replicated cheaply, because there are a lot of people with your skill, or because your function is automatable, or because it can be done offshore, your wage is constrained. If your output is rare, hard to replicate, and generates significant value for whoever is paying for it, your wage has room to grow. Now here's what the credential system did, structurally, over about 30 years. In 1980, roughly 17% of American adults held 4-year degrees. The degree was a meaningful signal of a certain kind of capability and a relatively rare one. Employers used it as a filter because it was cheap to use, and it worked adequately well as a proxy for trainability, conscientiousness, and baseline reasoning ability. By 2025, over 42% of American adults hold 4-year degrees. The signal is saturated. The information it conveys about the individual is dramatically weaker than it used to be because the threshold is lower and the population holding the credential is much larger. But the cost of obtaining the signal has gone up 5 or 6 times in real terms. You are paying more for a filter that does less work. This is credential inflation. The credential behaves exactly like a currency that was printed aggressively. When you print more of it, each unit buys less. The degree that distinguished you in 1990 puts you in the general population in 2025. So you need a graduate degree to do the distinguishing the bachelors used to do. And now you're looking at $200,000 to $300,000 in total educational investment for a salary that might be $70,000 to $90,000. The math does not improve with more schooling if more schooling doesn't produce proportionally more leverage over your income. And this is where the wage conversation needs to get replaced by the leverage conversation. Because leverage is the actual variable that separates people who build serious wealth from people who don't. Leverage, in its simplest form, means your output is not capped by the number of hours you work. It means you set up a system, financial, operational, creative, technical, where your effort multiplies rather than adds. Every person who has built significant wealth relatively quickly has done it through some form of leverage. Either financial leverage, meaning they used borrowed capital to amplify returns on assets, or labor leverage, meaning they built something that others execute, or media leverage, meaning their ideas reached far more people than their direct time could serve, or code leverage, meaning they built something that runs without them. The credential system was never designed to give you any of those. It was designed to make you a more employable unit of labor. That is a fundamentally different goal. Employability and wealth building are not the same system. They're barely adjacent. And the reason this matters so specifically for Gen Z is that the credential system was sold to them as the path to financial security. But financial security in the current asset environment requires capital, and capital requires either inheritance or leverage or both. The people who were told to accumulate credentials instead of understanding capital ended up with expensive signals and no capital, which puts them behind the starting line, not ahead of it. Let me also briefly address the retirement dimension, because this is a slow-motion disaster that doesn't get enough attention. Prior to the early 1980s, many American workers were covered by defined benefit pension plans. The deal was, you work for 30 years, we guarantee you a monthly payment for life. The employer bore the investment risk, the worker had income certainty. Starting in the early 1980s, driven by a combination of tax law changes and corporate incentives, the defined benefit pension rapidly gave way to the defined contribution plan, the 401k. The deal changed. You contribute money from your paycheck, we'll match some of it, and whatever you accumulate is yours. You bear the investment risk. The employer's liability is capped. For sophisticated, financially literate investors, this is actually better. You have more control, more flexibility, and if you invest well, potentially better outcomes. For the median American worker with no training in capital allocation, being handed control of their retirement fund and pointed toward a menu of mutual funds with varying and often opaque fee structures was roughly equivalent to handing someone car keys and then discovering they've never driven. Most people picked whatever the default option was, paid whatever fees were listed in the paperwork nobody read, and trusted that the system would deliver them something usable at 65. The beneficiaries of this structural shift were asset management companies, who now collect annual fees on what is estimated to be several $1 trillion of 401k assets. A 1% annual fee sounds trivial. Over 40 years on a significant account, it is not trivial. It compounds against you in the exact inverse of the way compounding works for you. It is the belt charging a maintenance fee for the privilege of riding it. And now the generation expected to fund their own retirements through market exposure is the same generation that can barely save anything after housing and student debt. Which means the 401k accumulation for Gen Z is starting later. Starting smaller and compounding against a higher baseline of required capital to actually retire on than any previous generation. The factory updated the compensation plan. The brochure still says comprehensive retirement benefits. Let me give you a scenario because I want to make this concrete. Take someone born in 2001. Let's call him Daniel. Daniel follows the standard script exactly. He's not careless, he's not delusional. He does what he was told to do. He goes to a solid state university, takes out loans to cover what financial aid doesn't, graduates in 2023 with $115,000 in student debt at an average rate of 5.8%. His degree is in marketing communications. He gets a job at a mid-sized company doing digital marketing and brand content. Starting salary, $54,000 a year. After federal and state taxes, Social Security, and Medicare, Daniel's take-home is approximately $36,500 a year. That's about $3,040 a month. His student loan payment on the standard 10-year repayment plan, $1,190 per month. He lives in a mid-tier city, Columbus, Nashville, Denver, something like that, because that's where the job is. One-bedroom apartment, $1,250 a month. Groceries, utilities, transportation. Phone, roughly $650 a month. That is $3,090 in fixed monthly expenses. He earns $3,040 a month. He is negative $50 a month. And that's before anything unexpected happens, before a medical bill, before a car repair, before a visit home for a holiday, before anything. Daniel is not doing anything wrong. He graduated, he got the job. He's paying the loans. He's not buying avocados, The math simply doesn't close. And the math doesn't close because the ratio of income to cost of existing has moved beyond the point where the standard advice produces a positive outcome. Now here's the thing. Daniel's options are not zero, but his options require a fundamental shift in what he's optimizing for. Option 1, stay in the current lane, grind for promotions, hope income outpaces fixed costs over 4 or 5 years. This might work if nothing goes wrong, if the job market doesn't contract, if he doesn't get sick, if his landlord doesn't raise rent significantly. It's possible, but it's also a scenario that requires a lot of things to go right for a long time. Option 2, reduce costs dramatically. Move somewhere cheaper, but accept that cheaper cities often have fewer job opportunities and lower salary ceilings. The math on this sometimes works, but it usually trades one constraint for another. Option 3, acquire a skill with leverage. Build something that doesn't require one-to-one time trading. This takes time and usually doesn't pay immediately, which is its own problem when you're $50 in the red monthly. But it is the only path that changes the fundamental ratio rather than just shifting numbers within the same broken equation. The insight here is not motivational, it's structural. Daniel's problem is not a mindset problem. It's a leverage problem. He's in a system that rewards certain positions with asymmetric returns, and he was trained for a position that doesn't have that characteristic. Fixing that requires understanding the system well enough to reposition, not just trying harder within the current position. Effort within a low leverage position produces linear output. The math on linear output in a world where costs compound doesn't work. I'm not speculating about this. I can do the arithmetic. You can too. One quick thing before the next section. The most common financial advice you'll see aimed at Gen Z on mainstream platforms is, at this point, a kind of performance art. Have you tried making a budget? Sir, he has $47 after fixed expenses. The budget has been constructed. The budget has been reviewed by multiple stakeholders. There is no line item in the budget that produces a 20% down payment. The spreadsheet is not the problem. The spreadsheet is the most functional thing in Daniel's life right now. Now I want to get to the thing that I think is actually the most important and least understood piece of this whole picture, which is the timing problem and how asset inflation interacts with when you're born. This is the part that makes people genuinely angry when they understand it clearly, because it reveals that a large portion of the wealth gap between generations isn't about discipline, intelligence, work ethic, or any variable that the individual can control. It's about when you arrived and what was already priced in. Here is the math, and the math is the argument. The S&P 500 in January of 1980 was sitting around 130 points. In early 2026, it's sitting somewhere above 5,500. If you had simply put money into an index fund mirroring the S&P 500 in 1980 and done absolutely nothing else, no analysis, no stock picking, no timing, no cleverness whatsoever, you would have experienced a compounded return of approximately 10% per year, give or take, over 46 years. $10,000 invested in 1980 became, without any additional contribution or decision, somewhere around $650,000 to $700,000 by now. The person who did that didn't earn that return through intelligence. They earned it through the combination of having capital available in 1980 and living long enough. That's it. Time and a starting base. The starting base produced the compounding produced the wealth. Now run the scenario for someone starting in 2025. They invest $10,000, which, given everything we discussed about Daniel's budget, is genuinely heroic savings over multiple years, into an index fund. If the next 40 years produce comparable returns, which is not guaranteed and actually not the central expectation of most serious analysts at current valuations, that $10,000 becomes roughly $450,000 to $500,000. Meaningfully less, partly because valuations are higher, partly because expected forward returns at current prices are lower than historical averages, and partly because 40 years of compounding starting at a higher price level is a different problem than 40 years starting at a depressed level. But more fundamentally, they're starting with $10,000. The person in 1980 started with $10,000 too. But $10,000 in 1980 represented a much larger slice of available assets, at much cheaper prices. The asset prices themselves were lower. The price-to-earnings ratios were lower, The entry point was structurally more favorable. This is the first mover advantage in wealth accumulation, and it is massive and almost never discussed plainly. The people who had capital in the 1970s, 80s, and early 90s got to compound that capital at historically excellent entry prices for 4 decades. The people entering the accumulation phase now are doing so at peak prices across most asset classes: stocks, real estate, private equity, even bonds. Which means the same starting capital produces meaningfully lower expected returns over the next 30 years than it did over the last 30 years. And I want to be careful here, because this is where some people go down a very unproductive road of pure grievance. The observation that you arrived at a structural disadvantage is useful information for making better decisions. It is not a reason to opt out or to wait around for a correction that may or may not come at a usable time. The housing correction has been imminent since about 2013. In some markets, it came briefly in 2022 and 2023. In most markets, it was more of a pause than a correction, and by 2025, prices have climbed back. Waiting for the system to become fair before you start engaging with it is a strategy that has a very clear historical track record. And the track record is, it doesn't work. The system adjusts on its own schedule, not yours. But here is the piece I really want you to sit with, because it's the one that connects everything. There is a political economy to all of this that has an internal logic. Asset price inflation is not an accident of random market forces operating in a vacuum. Asset prices, particularly housing and equity markets, have been substantially supported by deliberate policy choices over the past 4 decades. Low interest rates sustained for extended periods, quantitative easing programs that injected trillions of dollars of purchasing power into financial markets, capital gains tax treatment that taxes investment income at lower rates than wage income, stepped-up basis rules that allow massive estates to transfer intergenerational wealth while minimizing tax obligations, zoning restrictions that constrain housing supply. These are all policy choices. They were made by people. They could be made differently, but they were made by and continue to be sustained by the political coalition that benefits from them. In the United States, the most reliable voters, the people who show up in primaries, in local elections, in midterms, are disproportionately older, disproportionately invested in financial markets. The policies that benefit asset holders have political constituencies that show up and vote for them, because those policies directly affect the financial well-being of people who are paying attention and showing up. The policies that would benefit asset-poor younger adults, meaningful supply expansion in housing markets, restructured student lending, changes to the capital gains preference, face political resistance that is not mysterious or corrupt. It is rational from the perspective of the people resisting. If your house is your primary retirement asset, you rationally oppose anything that might reduce its value. If your portfolio is built on capital gains preferential treatment, you rationally support maintaining that treatment. Democracy does not produce outcomes that are fair to everyone equally. It produces outcomes that are proportional to who participates. And when participation is skewed by age and asset ownership, which it consistently is, the outcomes reflect those who participate. This is not cynicism, this is how the machine works. And map reading is only useful if the map is honest about the territory. Which brings me to, eventually the system will correct itself. Ah yes, eventually. The system has been correcting eventually in housing since about 2012. Student loan reform has been around the corner since at least 2010. The 401k was supposed to eventually produce equivalent retirement security to the pensions it replaced. Meanwhile, Daniel's student loan balance is growing at 5.8% a year, which does not wait for eventually. 5.8% is patient. It does not care about the political calendar. So, where does this leave us? Let's come back to the factory. The conveyor belt is real. The belt does still move. People do still exit with things, with assets, with financial security, with built net worth. It happens. I've done it. But the settings have changed, and the brochure at the entrance has not been updated. And the gap between following the instructions and reaching the exit is now large enough that many people are going to work the entire belt and find that the exit is somewhere they can't reach on the wages the belt pays. That's not a motivational problem. It's a structural problem. And structural problems have structural solutions. Not easy ones, not comfortable ones, but real ones. Here are 3 things that are actionable, and I mean actually not in the mindset shift sense, in the changes the math of your specific situation sense. The first is this: Stop optimizing for the credential and start optimizing for leverage. I want to be precise about what that means because the lazy version of this advice is just learn to code or start a business, neither of which is as simple as it sounds. What it actually means is this. Identify the specific mechanism by which your economic output could scale without requiring proportionally more of your time. That mechanism is different for different people and different skills. For some people, it's building media, content that reaches audiences at no marginal cost per viewer. For some people, it's acquiring and operating small businesses where your management of others creates value at scale. For some people, it's investing in assets that produce cash flow without your active participation. For some people, it's building technical systems that run without them. The specific mechanism matters less than the underlying principle. Your economic output must have the potential to grow beyond the constraint of your available hours. The credential system trains you to be a better unit of labor. Better units of labor get paid more per hour. But more per hour is still capped by the number of hours, and the number of hours is capped by the number of hours in a day. The exit cost of the factory is now so high that trading hours for money, even at a premium rate, does not get most people there in any timeline that looks like financial security while you're still young enough to use it. This is not pessimism, it's arithmetic. Check my work. The second thing, make your housing and investment decisions based on current ratios, not inherited assumptions. The psychological anchor of what things should cost based on what you observed growing up is extremely powerful and mostly harmful. Your parents might have bought a house that cost 3 times their income. If a comparable house costs 14 times your income, you are not dealing with the same problem they were. And the solution is not more discipline. The solution is either income expansion through leverage, geographic arbitrage toward markets with more favorable ratios, a different asset class entirely, or sequencing, building capital and higher leverage activities first and acquiring real estate later from a position of financial strength, rather than maximum stretch. There are markets in the United States and internationally where the home price to income ratio is still 5-to-1 or lower. Those markets exist. They often lack the job density of major metros, which is a real trade-off. But the assumption that you must live in the most expensive possible market to have a viable career is increasingly untested given remote work infrastructure. This trade-off is worth examining honestly rather than defaulting to geography because of social or perceived status reasons. On investing, start regardless of amount. $10 a month compounding for 40 years is better than waiting until you can invest real money. The timing advantage is irreversible. Every year you delay investing is a year you cannot get back. Even small amounts at early ages compound into meaningful numbers. The math on this is not approximate. It is precise, and it runs in your favor if you start, and against you if you wait. The third thing, understand the political economy of the system you are inside. This is the least sexy of the three and probably the most important. The financial rules you operate under are not natural laws. They are negotiated outcomes, carried interest tax treatment, capital gains preferential rates, estate and inheritance rules, zoning regulations, student loan bankruptcy protections for lenders. These are decisions. They were made by specific coalitions with specific interests. They could be changed. Some of them will be changed. Understanding which ones are likely to change in which direction and on what timeline is genuinely valuable for making financial decisions. More immediately practical, it tells you which structures and vehicles to use right now. If capital gains receive preferential tax treatment, you want more of your economic output coming to you in that form, rather than wage income. That means owning assets that appreciate, owning equity in things you work on, structuring your economic participation in ways that put you on the ownership side rather than the employment side, wherever that's feasible. This is not a moral argument. It is map reading. The current rules favor asset holders. Therefore, becoming an asset holder as quickly as possible is rational. If housing has structural political protection from supply-side reform because existing owners dominate local political participation, that's a signal about expected price behavior in supply-constrained markets that you can factor into your decisions. I'm not telling you what to do with that signal. I'm telling you the signal is real and you should be incorporating it consciously rather than ignoring it. The factory hasn't changed because nobody noticed the new settings. The factory is running exactly as designed by the people whose interests it currently serves. They are not villains. They are people who optimize the system for their outcomes and then lost track of the fact that the optimizations disadvantage people arriving after them. Understanding that process is the entire prerequisite for routing around it. You were set up to fail before you were born. That is structurally, mathematically, factually true. The settings of the machine you were handed are less favorable than the settings your parents received by a measurable and significant margin. The entry costs are higher. The exit costs are higher. The credential required to get on the belt costs more and delivers less signal. The assets that produce the exit have been bid up by 40 years of favorable policy for existing holders. And none of that is your fault. But fault is not a useful variable. It doesn't change the math. What changes the math is understanding the machine accurately, identifying where the system still rewards specific behaviors, and positioning yourself in those slots rather than in the ones the brochure recommended. The brochure was written for a different machine. You're working with this one. If you want consistent analysis of how this machine works, how money actually moves, and what the incentive